half an hour away from the Open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Mann with David Ingles.
Let's get your top stories today. We're looking at oil prices up across the curve on a CNN report that Israel may be preparing to strike Iranian nuclear sites. Asian equities facing a choppy session after U.S. stocks struggled to hold on to gains.
Elon Musk tells Bloomberg he's committed to leading Tesla while paring back his political spending in a bid to ease investor concerns.
Plus, CATL's billionaire founder pushing back on U.S. claims of military links, speaking to us in Hong Kong after shares soared following the biggest listing this year.
Yeah, we're getting some latest lines out of the Ministry of Commerce in China and really reacting to these U.S. chip ban and what we're hearing here so far. So they're saying that the U.S. abuses export controls. They're taking measures to safeguard the rights and interests. But they say U.S. measures on China chips do hurt the global supply chain. And they're saying these measures are typical of unilateral bullying. Some pretty harsh words coming through from Beijing here this morning. And you got to wonder how this is going to really impact the whole relationship and this trade truce that we're currently still in.
Yeah, and it looks like to be on softer footing. It gets to the point there that Yvonne was just underscoring there. They are urging the Americans to immediately correct the wrong practices in place, and that they are saying that anyone helping these measures in the U.S. may violate Chinese law. There's that story. There's the CNN reports playing out across these markets. There's the fact that equity markets have done very, very well going into this week as well. So all that's playing out really across price action. So you have Asian benchmark coming on your screens very, very shortly. We should see red, if not slightly to the upside. We're looking at other things as well. We'll talk more about that in a moment. Gold, as you can see, is bid. Aussie yen, which is a very decent gauge of risk appetite right now, falling today. And the Japanese 40-year yield, which is an idiosyncratic story to Japan, and the BOJ stepping back and the lifers not coming back in. But separately, of course, concerns over government spending, more or less globally, is a story playing out there. So the 40-year yield is at 362. We had an extremely weak 20-year auction yesterday out of Japan. S&P futures, bottom of your screens, down about 1/10 of 1%. We talked about oil prices coming up on your screens here. Brent, gapping higher at the open about an hour back. West Texas up across the curve, and Shanghai is just coming online right now, 0.7 of 1%. Right, now into the China stories. Apart from CATL, which obviously we'll be looking at day two right now, a 16% pop at the first day of trade. Earnings are still very much in focus still, so several to watch today. ZTO out with earnings, as with Bilibili. Xpeng and Baidu are on deck today. Futures coming online in Singapore and here in Hong Kong. Dollar China, dollar Hong Kong. And I mentioned dollar Hong Kong and the drop we're seeing in HIBOR. 2022 lows, big drop in recent weeks. You had a big drop yesterday, and we'll watch it very closely again today. On the back, again, more breaking news coming through here out of the Ministry of Commerce. Just another item to add to the already long agenda today.
Yeah, you take a look at what's really in store. You talk about the earnings. Of course, we're going to latest take there on what Xpeng and Baidu there. Also, we mentioned about CATL day two. Are we going to see another day of outsized gains here? Shanghai oil we talked about, given what we've been seeing with that CNN report. There's a CGB sale going online. HIBOR continues to be very much in focus. And of course, we talk about that briefing that's happening this morning as well. But yeah, HIBOR dropping to the lowest that we've seen in about 3 years.
Yeah, and that's really helping sales here in the city, I think, which is, I guess, a silver lining to many of these things that we're looking at. Hong Kong property prices, there's a good story coming out today, and we'll talk more about the New World story in a moment. But again, the market themes that we've touched on today, really just to set us up for the day, right? So it's been obviously a very steady foundation to be able to, I think, absorb these huge listings here in Hong Kong is number one. But the oil story, and I guess to some extent the complacency that Jamie Dimon mentioned across these markets in recent days might be starting to play through. So markets removed quite a hefty amount of risk premium, and that's being baked back in to some extent today.
Yeah, just given the geopolitics, right? But it certainly has been a volatile ride when it comes to oil prices are concerned. When you take a look at how this Iran deal is going to play out as well. So you take a look at oil prices. Let's get more into that CNN report as well, studying U.S. intelligence sources saying that Israel may be planning a strike on Iran. Let's bring in our senior energy reporter, Stephen Sapchinsky. He joins us live from Singapore here. We're already seeing oil markets move. Steve, just bring us kind of up to speed on what the latest is.
Yeah, I mean, I think we're just, the oil market at least is trying to figure out exactly what this means. It's reacting to it. But the CNN report suggests that there's U.S. intelligence that shows that Israel might be preparing a strike on Iran's nuclear facilities. Of course, that would be a ratcheting up of the conflict in the Middle East. Now, where does that go for oil, right? Even though there are sanctions against Iran, there are still flows out of the country on dark fleet vessels and other means. So Iran has been their output, according to Goldman Sachs, is about 1 million barrels of oil a day. Now, when you look at that, if for some reason if there is a strike, and in a worst case scenario, it takes out all of that supply, if you remove 1 million barrels of oil from the market per day, you're going to see oil prices, a reaction of about $8 higher per barrel for oil benchmarks, according to Goldman. Now, that's why you're seeing this bullish impact, because any sort of strike, anything that could reduce oil output from Iran, anything that could raise the conflict in the Middle East, which is a major oil-producing region, that risks supply. And if it risks supply, you see higher prices. Now, I do want to preface all this to say that even if there is any impact on Iranian oil output, there is spare capacity in the rest of OPEC. And according to Goldman, they could theoretically just kind of shift supply around and cover that hole. So fundamentals-wise, long term, you're not going to see any, shortage per se, but at least in the short term, the market is preparing for that bullish element, that shock and awe if it does come, and they want to be prepared.
Stephen, thank you. Our senior energy reporter, Stephen Sapchinsky, joining us out of Singapore this morning. Let's bring in Joe Little, Global Chief Strategist at HSBC Asset Management. Apart from the oil story, I mean, you take a look at how assets are doing. Stocks seem to be doing okay. We're back in the green for 2025. Bonds are obviously questioning a lot about the fiscal policies in the U.S. And then you have the dollar that continues to edge lower. Is it still the end of exceptionalism theme that is intact, or where are we in that debate?
Yeah, thanks, Yvonne, and thanks for having me on again today. You're right. The end of exceptionalism is the big story that investors want to talk about. I think it's probably helpful to break down the jargon a little bit, because when people say end of exceptionalism, it's often not that well defined. So I like to think about it in terms of exceptional GDP, exceptional stocks, and then the exceptional dollar. And each of those has been a really important aspect of the story for global investors over the last decade or so. And the problem is that the cracks are starting to show in each of those elements. So if we think about the GDP story, the big boost to GDP has been around the fiscal support, immigration, both of which are checked now. To greater or lesser extents. The stock market story has been about these supernormal profits, mega cap tech, the Mag 7 after the DeepSeek moment, big question marks there. Still, we see US equities with premium valuations, which doesn't bode well for future returns. And other global stock markets are offering as good earnings profile over the next 12, 18 months as we see in the US now. So a big change on the stock market outlook. And like you mentioned, the dollar has been behaving in a very strange way. Many global investors very confused at the way the dollar is behaving. Stocks selling off, bonds selling off, and the dollar selling off. There's a sort of an emerging market theme there. It doesn't look like what we're typically used to seeing. The dollar is the safe haven story. So the combination of the dollar still being 2 standard deviations expensive versus most global currencies, and the macro vibes looking a lot more negative than what we've gotten used to, means that I think the cracks are starting to show in that exceptionalism story on the economic side, on the stock market side, and on the currency side. And so many investors want to rotate into Europe, into Asia, into other parts of emerging markets.
In recent years, the Fed has served as, I guess, the kryptonite to be able to reverse maybe some of the trends.
Yeah.
Could they be that catalyst that maybe reverses, not all of that, but some of that, for example? Can I look at the Fed and say if they start cutting, some value then emerges in U.S. markets?
For sure, that's the shock absorber. That's always the shock absorber. Cutting the cost of capital is the shock absorber to allow PE multiples to stay elevated, rather than the bad macro vibes having been forced to run through equity markets. But the problem is, David, that the Fed is in a bind. The implementation of policy uncertainty and tariffs gives it a stagflation light sort of situation, at least in the very near term. And that means that the Fed is reactive rather than proactive. And that's a big change for investors, because we're so used to the Fed being proactive, cutting aggressively in the early phases of a slowdown. And for the last decade or even more, most central bankers have really been focused on this idea of macro stabilization, growth stabilization, stabilizing financial markets. They haven't had to worry so much about the other side of the mandate. They haven't had to worry so much about the inflation piece. But a mini stagflation shock from the tariffs, that means that they're a bit more two-minded, and it forces them to be reactive. So for US stocks, you've then got a kind of triple problem, really. Premium valuations in terms of Ps being above long-run norms. Profits outlook still, I mean, having been downgraded, but still 10% profits over the next 12 months is the analyst expectation. Still looks a little bit elevated given the bad news that we're seeing on confidence, the vibes around the economy. And there's a big question mark around the shock absorber. If the Fed is in reactive mode, if the bond market is misbehaving, as it has been doing, rising long-term bond yields, the relative valuation story doesn't free up wriggle room or a margin of safety for stocks. So I think, again, it feeds into this idea of US exceptionalism being challenged and questioned. And you can see on that basis why investors are preferring more lowly valued stock markets in Europe or in Asia with a catalyst from policy or from macro or from central banks being more proactive.
It's, I think, to the point you're making, it's, you know, as large as the U.S. stock market is, it's easier to find alternatives, right? You go to Japan, you go to Europe. But the bond market seems to be, you know, the Fed's cutting. Why are yields moving up? And, you know, the Treasury market, that's the benchmark for the global financial system.
Most liquid.
It's the most liquid. It's hard to replace, as Moody's called this week. And I'm wondering, you know, what are the second-order derivatives that we have to be paying attention to? Like, what does this do if yields keep pushing up in the U.S. Treasury market?
Well, it's remarkable, and it's remarkably important. So you're exactly right. In some respects, the key development. So I like to joke that it's the reverse conundrum. You might remember in the early 2000s, Greenspan and then Bernanke had this idea of the conundrum on interest rates. They were hiking interest rates, 16, 17 mini hikes, 25 basis points hikes from 2003 onwards. And bond yields were stable or falling at the long end of the curve. And so Greenspan famously called this the conundrum. Bernanke did a lot of research, said it's global savings, having a glut of global savings, forcing long-term bond yields to stay capped and even move lower. But if you fast forward to today, we're in a totally different environment. It's the reverse conundrum, the opposite of the conundrum. The Fed started cutting at the beginning, or the end of Q3 last year, the beginning of Q4, we had those cuts responding to the weaker labour market data. So we've started the cutting cycle. And normally you would expect long-term bond yields to be at least stable or falling slightly following the beginning of the Fed cutting cycle. And instead, we've got risk premium, fiscal worries, concerns around the US fiscal position really coming into the long-term bond yield and a bear steepening of the curve playing out. And it changes things materially. It changes relative valuations. It forces investors to think again about where safe assets are. And it challenges the growth story in US stocks, which had already become 70% of global equity market weight. With hindsight, that looks like a
too much.
A top, doesn't it? A topping process. So profound implications. And then really big implications for other global bond markets. You've probably seen Switzerland has moved back into negative bond yield territory. You can see these other safe havens are not as deep, not as liquid. So as capital moves to other locations, it really has an outsized move on prices, forcing yields materially lower as investors look for other safe havens, bond substitutes away from longer-term treasuries.
Okay. Joe Little just getting warmed up there. We'll have more with him. It's a different world. You know, China's been ramping up its imports of gold, I think, for one. It's been stepping up from the U.S. Treasury market. Chief Global Strategist there at HSBC Asset Management. All right, just ahead here in shows, we'll continue our markets coverage here. Goldman Sachs will be joining us at about this time in the next hour. So they've raised their GDP forecast. They have an assumption of a 40% tariff. And with that, they've also raised their equity projections as it pertains to the greater Chinese market. So that comes up at those times on your screen.
Yep, plus CICC joins us to talk about Hong Kong's IPO pipeline after CATL's blockbuster secondary listing. Shi Qi joins us a little bit later on. We're counting down to the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Futures are up this morning. All right, your reference rate just crossing through the terminal here right now, 719.37. That is a bit stronger, actually, much stronger than what the analysts were expecting of a 721 sort of print here. So once again, you are seeing the PBOC holding steady on where they want to go with this currency in some ways. And there you go. We did see a bit of a reversal in dollar China here after those MOFCOM comments that we got earlier.
Yeah, a reminder that while we are in this 90-day truce, they're still negotiating.
Yeah.
There could still be complications, and we don't know how the world looks after 90 days. And I think that's really the backdrop of, equity markets have done very well, and do we need to be afraid that they've done so well? And what the replacements are, as far as this sort of recreating a synthetic basket that could mirror the U.S. equity market. Joe Little still with us, Global Chief Strategist at HSBC Asset Management. Yeah, so let's talk about the Plan B, Plan C, Plan D, Plan Es as we try and sort of create a sort of replacement basket.
Yeah, you need a few scenarios. So, you're right. This idea of how you complete the portfolio, how you find substitutes in different parts of the world. In some respects, the equity piece is the most straightforward because we can see lower valuations in Europe, lower valuations in China and in other parts of Asia, with obvious catalysts for the market to perform. So particularly policy support in Europe and in China, that at least puts a floor under the economic performance and the market outlook, but acts as a catalyst to reboot animal spirits and confidence. You can see the progression of the news around nominal GDP in China, for example. That's so important for the profit situation. And you've now got an outlook for the next 12 months where analysts are expecting 10% profits growth in China. It's the same as in the US. So why pay for the premium multiple when you can have that tech exposure in the rest of the China market, exciting themes on AI, robotics or biotech at a material discount to what you can access or what's being offered in other parts of global equity markets? And in Europe, it's a similar story, with the addition of the ECB potentially being a lot more proactive. Because remember that although for the US, the policy uncertainty and the tariff shock is a mini stagflation challenge in the near term, for the rest of the world, it's a confidence shock, which means it's a pure growth effect. And that, in an environment like in Europe, where the economy is already in stagnation of sorts, that forces the hand of central bankers to be a lot more proactive. So you've got policy easing from the ECB, you've got the German fiscal support, infrastructure plan and defence, and you've got European valuations at discounts relative to what you see in other parts of the world, especially in the US. So this rotation away from the US into EFI, I think, is a really important macro theme. And then the other piece is, to your earlier point, David, around what you do with your treasuries exposure. Yeah. Do you look for alternative diversifiers in other parts of global fixed income or in different assets altogether?
So where do you prefer to take that duration risk then?
Yeah, so I think Europe makes sense. Yeah. The ECB being more proactive. You can look at the UK curve as well, because there's a similar story in the UK with the Bank of England. The Asia bond market is also very relevant for investors. Something like India is seen as a relative safe haven, relative harbour amid the tariff challenges. Yields are elevated. It's liquid and accessible for investors now post the inclusion in the bond index. So other parts of Asia fixed income also have a role. Many investors I talk to around the world are also looking at alternative assets. Yeah. Right. So a hedge fund allocation, or maybe some of the more illiquid diversifiers, something like private credit or securitized credit. These are relevant options. Clearly not for everybody, but another way to try and add a little bit of resilience to the portfolio. So we imagine the situation now where, if you like, with the benefit of 2020 hindsight, the 60-40 portfolio, 60% US stocks, 40% bonds, that's been a kind of perfect way to control our returns, good risk-adjusted returns over the past. But that's history. And the future shape of diversification or a resilient portfolio is a bit more nuanced. There's more coloured pieces of pie in the pie chart as you look for resilience in other parts of global fixed income, in credits, in other parts of emerging markets, and in alternative assets as well.
Is there still a grab for yield? Like when rates were at zero, there was this rush to find yield, but now we have yield. I'm wondering, so you mentioned a lot of instruments in fixed income. High yield has done very well. How do you guys think about credit and high yield in this sort of environment where you could actually get almost as much yield, not without giving up too much in quality, I guess? What are income strategies looking like to you?
The all-in yield,
Yeah.
everything chucked in together. So the rate exposure and the credit exposure across credits looks elevated. And that's part of the story in private credit as well, because you get the so-called illiquidity premium, adding another little element to that. So the stacked Lego block of all of the different returns and risk premia that you're getting when you access that asset class is pretty high. And in some areas of high yield or private credit, equivalent to typical equity returns, 7, 8, 9% achievable in some strategies. The challenge is you've got to know what you're doing, and I think being selective is really important. So in the credit space, tend to favour the higher quality parts of credit at this juncture. So it's the investment grade area rather than the high yield area that I'd really focus on. I think it's more of a stock picker's story, a credit picker's story as well, because of the need to be really thoughtful about what balance sheets to focus on, how to manage that credit risk. But there are some interesting areas in the private credit space where you know what you're doing, and something like securitized credit, which is floating rates, but still has premium credit excess returns associated with it as well.
Joe, we got to leave it there, but thank you so much. Great to have you here.
Thanks
Joe Little, Global Chief Strategist at HSBC Asset Management. We got plenty more ahead. This is Bloomberg.
All right, there's some premium still being felt in U.S. assets. As you can see, U.S. futures are down. Oil is continuing its spike, but as you can see, we've shaken it off as we move into the Asian session here.
Yep, so maybe things a little bit looking better. You take a look at some of these comments coming through from the Ministry of Commerce there. China hopes to work with the U.S. in promoting stable ties, so maybe softening a little bit some of the commentary that we heard from earlier this morning. Again, we are counting to the opens there in China. Futures are punching slightly higher this morning. Got a lot of earnings to tell you about as well. We'll get you a preview coming up. The Open is next. This is Bloomberg. Beautiful day out of Hong Kong here this morning. It almost looks like a picture, Dave.
Yeah,
it's nice.
A picture of a wall of sweat.
And
if you're out there.
It's not showing the humidity. Yes, obviously, when we get to June now, close to that. Take a look at the markets, though. Looking pretty sunny as well, as futures are pointing to this morning. You take a look at the Hang Seng. We're up about 1/5 of 1%. Yesterday, it was all about CATL, so we'll see if we actually get another second day of decent gains here for that. That really did lift a lot of the benchmark yesterday. Keep in mind, we have Morgan Stanley in just the last couple of minutes. They're also upgrading their GDP forecast for the year for China. So 2025 now, that forecast is to 4.5%. Laura Wang and her team also raising their benchmark targets for CSI 300 as well as MSCI China. We'll break that down for you in just a little bit. Now, take a look at your open here right now. We talk about the earnings on tap. We'll get to that a little bit later. Onshore markets are looking like this here right now. We're flat when it comes to the onshore markets here. Yields are not moving a whole lot here either, but we're watching very closely Shanghai crude, given what we've been seeing in oil prices. CNN reporting that Israel might be ready for some sort of attack on Iran. So Shanghai crude is up some 2%. CATL, these are the A shares. Keep in mind, there you go. After yesterday, we actually did see the onshore stock actually lower in Shenzhen. We're seeing maybe a bit more of a recovery here. We're up some 2%.
We're up 5%
CATL.
now.
5% now,
in
is
Hong
it?
Kong, yeah.
Well, they're both
$320.
going up now. Yeah. So it looks like both the stocks are looking pretty good here as well. Let's look at the boards and take a look at that and see how Hong Kong is faring. That still is where the story is. HS Tech is flat. MSCI China also has seen a little bit of upside here, but keep in mind we're watching some key earnings like Baidu. That's down some close to 1% here right now, and we're watching very closely what happens with the tech space. Bilibili had some pretty good results. That's why we're seeing the stock in Hong Kong doing quite well. Xpeng is also out later on here today. But let's see, CATL, as Dave mentioned, 5% once again. I mean, yesterday we hit at least a 16% upside.
We were 16% at the close, thereabouts. We were 5% up 4 now. Still not bad, though.
Yeah.
Trillion yuan club.
Yeah, and we heard from the founder himself CATL's chair, Robin Zeng, is pushing back on U.S. accusations that the company poses a national security threat. In January, the U.S. Defense Department added the Chinese battery giant to a blacklist of companies with alleged links to the PLA, I should say. For more, let's bring in our EV supply chain and aviation reporter, Danny Lee. He's with us. So tell us a bit more about this conversation. It seems like a lot of it was focused on the U.S. and China relationship.
Yeah, that's clearly top of mind for someone like CATL. But first off, that Robin Zeng telling Bloomberg News that the accusations around its role in supplying the Chinese military is completely groundless. And from its point of view, it will do business with anyone that shares its values, so ethical ones, per se. And it maintains it would never do any business knowingly with any military actor or for warfare. So it's very firm in its view on that. And so that Pentagon blacklisting back in January or so, it would never be able to supply the US military. So maybe it would never want to in the first place. But it was very firm on that. But it has been dragged into all this noise pre-listing around with the US and whether the US House committees are pressuring banks not to do business with CATL. So there's been a lot of pressure there.
Well, speaking of pressure and speaking of the listing here, we understand, and tell us more about this, that the support, or at least reduced support for the listing at JP Morgan came from the very top.
Yeah, and I mean, several letters, Robin Zeng said, came from Jamie Dimon himself in order to express support. And, it's a key supporter there and key vote winner there in there as such. So, clearly very vocal in that. And, when you look at the broader kind of China-US relations, we got this tariff situation. It's interesting that now CATL says it's actually going to ramp up its exports into the US because we have this 90-day tariff reprieve. So it didn't expect to see much of an impact from tariffs. It looks to capitalize on this reprieve in the meantime. So we'll see what happens going forward.
Danny, thank you so much. Danny Lee there, our EV supply chain and aviation reporter. On your screens, as we just showed you, we're still looking at gains here in CATL, up 3.5%. In the early goings here in Hong Kong. Now, one of the lead sponsors, of course, of that massive listing was CICC. For more on really what took place behind the scenes, what led to the deal, what the pipeline looks like, let's bring in Shi Chi, Deputy Head of CICC's Capital Markets Department. Good morning, and thank you for coming in to join us today.
Good morning, David.
So tell us about the process. Now we're here. It's day 2. The shares are doing well. What was it like taking this massive deal to the market?
Okay, yes. Yeah, let's start from CATL. Yeah, we saw a very successful and wonderful debut performance of CATL yesterday, and it's already running ahead of its A-share price and with a premium now. Yeah. And so it's really a very strong booster to the Hong Kong market as well as IPO market. Yeah.
Tell us a bit about the pricing, because it was interesting that you didn't see that massive discount from the A shares. What was the thinking behind that?
Yeah, actually, more precisely, it is when we set up the price range cap, it's actually we just take the A share price. So you can say it's a zero discount deal. Yeah, the discount comes from the price rise during the book building days, which is actually quite rare for the secondary foreign offering. Yeah, like ADR back to Hong Kong, like other A2H share offering. So the discount comes from there. So yeah, and also I think it depends on the company's profile as well as absolute valuation at this moment. Yeah. And also actually A-share pricing power also seems work in this deal. Yeah. And almost 50% of the deal was allocated to Cornerstone when they have to meet the zero discount, which means actually they have a very positive view on the market as well as the company, at least in the future of the 6 months.
What does this now tell us about the future listings and the trends around how we discount or price, or do we put a premium now because things are going well, or was the pricing dynamic for this deal more specific because it was CATL?
Yeah, that's a very good question because, there is another $1 billion deal of the A2H offering in the market. Yeah. And it's still as traditional with a price range and a reasonable discount. Yeah, because of its relatively high valuation in A-share market. So I must say that it's a case by case, but to be honest, and this CATL's pricing will narrow down the valuation gap between the onshore market and the offshore market. It will help the pricing in the other deals.
Can you tell us what you know about the pipeline that's coming up?
Yeah.
Are we likely to see more blockbuster deals like this one, or maybe more smaller scale now?
Yeah, actually, in this year so far, the IPO size is already almost 70% of the deal of the size of last year. So, and at this moment, there are still over 150 activity application in the Hong Kong Stock Exchange.
Right.
Yeah, and A2H is of course a major theme of this year, and as we know, we have already around nearly 10 company with 100 billion market cap RMB is already applied the application.
Right.
Like Sanyi, like Sanhua Intelligence, like Haitian Flavoring, and also other not listed company, Cherry Auto. Yeah, these are also all billion-dollar deal that will come in this year.
Yeah.
How would you describe demand as you guys try and market these things? I mean, are there enough cornerstone investors out there? Is there enough money to absorb more mega-sized deals coming to Hong Kong?
Yeah. I think let's CATL as an example. Yeah, is in this year compared to the earlier A2H offering, the percentage of the allocation to the global money already picked up significantly. Yeah, we see actually Middle East sovereign funds and also some Southeast Asia sovereign fund, as well as other global long only, actually add their allocation to China. Yeah. Just for example, a leading European long only fund, they're already existing shareholder of its CATL A share, but they don't sell any A share. Their emerging market just add allocation in CATL. Yeah.
It seems like with the CATL listing that China seems to be backing these sort of secondary listings, or whether it's an ADR coming back home. What do you make of, and what insights can you give us about the regulatory framework now?
Yeah, I think if looking back to the last year, some of the A2H share offerings, the regulatory actually is still looking at the response of the market. And media was very successful, and also later Shunfeng and other deals are very successful. So the regulator actually is very supportive for those leading Asia company to get into the global market. That is actually also in line with the firm's strategy of the global business expansion. Yeah, and also the companies have a more efficient way to do fundraising after they get listed, and to support their merger and acquisition and other business expansion. Yeah.
What about the onshore market? What's the outlook for deals there?
Yeah, I think for onshore market, if looking as a IPO or fundraising market, I think they are actually in a very stable pace.
Okay.
Yeah, and the different main board, Beijing Stock Exchange or SSE, the other board are all absorbing their different type of firms.
Right.
Function quite well, and we see some recovery of the regulators' attitude to take to go ahead with some more deals. Yeah, and also there are also some policy incentive for these real tech companies, and to help them, to support them to get fundraising to help build their business.
Yeah, there was a call a few years ago of trying to get these tech companies to list on these tech boards.
Yeah.
Like
the Beijing board,
the Beijing board, the Star board.
Yeah.
What's happening there now?
Yeah, I think they are still, just as I said, they are still taking relatively stable pace for these companies, and the priority actually are these tech companies, and other companies will relatively take a more strict criteria to make sure the quality of the company is okay. Yeah.
So we're looking at a big source of deals onshore coming to offshore. Are there any other markets in the world where we're expecting more listings to come from? Europe, Middle East, maybe the U.S., for example?
Yeah, sure. Yeah, because ADR back to Hong Kong is already going on for many years. And given the geopolitical tensions and also the difference of the policy priorities, I think more and more, still there are some U.S. company, listed China company, considering Hong Kong stock market as an alternative. And also the city's regulator is very proactive to welcome this company to back. Yeah, they actually set up many new policies to welcome their back. Yeah, and also the Hong Kong market has the ability to absorb this offering. So it's already worked for many years, so I think it will go on.
So we asked you before the show started whether you were at the Hong Kong exchange during the listing. You said you were back in the office because it was really, really busy market. Is your team getting enough sleep? Because it seems like you guys are extremely busy these days.
Yeah. Our team is quite busy during past months. Actually, in addition to IPO, we also have to, because secondary block trade and also follow-on offering are also very active. You see the BYD and also Xiaomi. Above 5 billion deals already happened in this year. So there are already 3 deals above 5 billion.
Shiji, thank you so much. I hope you guys get some rest now. Deputy Head of Capital Markets Department at CICC. But yes, it's good busy. Right?
Yeah.
We like being good busy, too, here.
We love that.
At Bloomberg. Take a look when it comes to some lines crossing through from Jensen Huang, the NVIDIA CEO, is speaking and talking a little bit more about these AI chip export controls from the U.S. So Jensen Huang saying that they were a failure in terms of what AI and what China can bring. He sees $50 billion China AI market in 2026. So he's still betting on, I guess, that market there in some ways, but certainly wrapping up a very, very busy Computex for the NVIDIA CEO. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China show. Shares of Tesla closed higher in New York overnight. That's after CEO Elon Musk said he is committed to continue running the company for at least 5 years. Musk also took aim at the Delaware judge, who he called and labeled differently, who has twice ruled against his massive pay package. He spoke with our Michelle Hussein at the Qatar Economic Forum taking place in Doha. Have a look at this.
Tell me then how committed you are to Tesla. Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all?
Well, no, I might die.
Okay, short of that.
I can't be see if I'm dead, so there's a slight amount of
Does that mean that the value of your pay doesn't have any bearing on your decision?
Well, that's not really a subject of discussion in this forum. I think obviously there should be compensation for, if there's something incredible is done, that compensation should match that something incredible was done. But I'm confident that whatever some activist posing as a judge in Delaware happens to do will not affect the future compensation.
This is the judge who twice struck down the $56 billion pay package that was awarded to you. I think the value on the current value of stock options. Yeah.
Not a judge. The activist who is cosplaying a judge in a Halloween costume.
Okay, that's your characterization. I think on the current value of stock options, I think the actual
justice according to the law.
On the current value of stock options, I think the value of that pay package stands at about $100 billion. Are you saying you are relaxed about the value of your future pay package? Your decision to be committed to Tesla for the next 5 years, as long as you are still with us on this planet, is completely independent of pay?
No.
It's not independent. So pay is a relevant factor then to your commitment to Tesla?
A sufficient voting control such that I cannot be ousted by activist investors is what matters to me. And I've said this publicly many times. But let's not have this whole thing be a discussion of my alleged pay. It's not a money thing. It's a reasonable control thing over the future of the company, especially if we're building millions, potentially billions of humanoid robots. I can't be sitting there and wanting to get tossed out by, for political reasons, by activists. That would be unacceptable. That's all that matters.
That was the Tesla boss, Elon Musk, speaking, of course, with us at the Qatar Economic Forum taking place there. Very interesting exchange there, of course, with our colleague. Right, breaking news. CATL, the world's biggest listing, listed yesterday 16%, up 5% right now. We now know that the green shoe option was exercised, taking the size of the deal up to now $41 billion in terms of the amount of money raised. And as you can see, shares are now, as our previous guest from CIC, Lead Arranger, pointed out earlier on, the green shoe was exercised and the shares are now trading, in fact, now at a premium to the A-share markets. Yeah, so it's been a good week.
The demand is there,
Yeah.
so they had to exercise this option. So certainly something that we were anticipating as well. We continue to see that stock climbing this morning. We got plenty more ahead. This is Bloomberg. All right, we are checking Baidu shares here this morning. The shares are slightly lower ahead of those first quarter results here. And let's get the take from Bloomberg Intelligence. Robert Lee says he sees more challenges ahead for Baidu, putting its outlook under pressure. Our senior analyst joins us right now. Robert, what should investors be focusing on?
Okay, well, as you're aware, at its core, Baidu is still a search engine business, often referred to as the Google of China. So I guess we'll be looking at the core search business, which is revenue within which is driven by advertising. And that has been under pressure for a number of reasons, which I guess we can go on to in a minute. But I guess the core focus, again, is going to be on AI. So Baidu has various AI interests, both within the chatbot sector, the large language sector. They're also investing into robo-taxis and AVs. So there's an awful lot going on. And I think the thing that will catch the headlines tonight and into tomorrow is the growth that they're seeing on their AI cloud business, in common with Alibaba and Tencent. So I think that will be really the main focus.
And, Alibaba and Tencent shares are up. I think one is up 25%, the other is up 40%. But, Baidu's not even close in terms of performance. What's gone wrong?
Yeah, right. Well, going back to their core search engine business, back in the day, Google or Baidu were the only places to go if you wanted to search something. But these days, you've got so many different options. Most major apps have got a search function. And also, generative AI is pretty good at sort of intelligent filtered searching. So that has diluted Baidu's market share. And obviously, advertisers are going to put their dollars where consumer eyeballs are. So that core advertising business, which is the cash cow business, which underpins and funds the investments in AI, is under immense pressure. So I think that's one major issue. And I would say the other thing is, at the end of the day, unlike these big tech platforms, they're a medium-sized business. They've spread themselves too thinly. They're trying to do too many things. Because take AVs and robotaxis. There are so many companies active in it at the moment. You've got the automotive specialists, the BYDs, etc. You've got other specialists like Pony AI. So I guess it's hard to see where Baidu's competitive edge is on that front. And very hard to compete when you're coming up against these very large, more laser-focused and well-capitalized competitors. So I think they're trying to do too many things. They should focus on where their core strength is.
Okay, so maybe stretching themselves too thin, what are some ways that they can get themselves out of this hole? And do you think there needs to be some sort of change in management then?
I guess on the management side, far be it from me to call for a change in management, but I think they do need a new strategy, a new direction, because, again, I think to be fair to them on the AI front, if we had this conversation 2 years ago, they had some market leadership. They were one of the first into the market. But progressively, these big tech platforms have come in. And I think is often the case in technology markets, and particularly in China, scale wins out. So it's very hard for a medium-sized company to compete against these huge tech platforms. I mean, I was trying to think of a good analogy for this, but, Baidu sat there on the hill with a pea shooter when Alibaba and Tencent are coming over with, massed ranks of artillery and all the rest. That's a slight exaggeration, but I think there's truth in that. cloud computing is a scale business. You need multiple data centers in multiple geographies. It's a very capitally intensive business. So if you look at the scaling resources that Baidu has, it's much more limited, and that's their challenge. They need to focus down, and they need to focus where they have a competitive edge and they can drive ROI.
Robert, thank you so much. Robert Lee there, our senior analyst, ahead of the Baidu earnings coming through. In fact, Baidu, Xpeng are just the two names we'll be tracking, given, of course, the earnings story out there. ZTO was out, and yeah, really coming through here, as you can see in the results, and the market reaction to those results down about 6%. Other things happening, CATL, we're looking at that day 2, and shares were up. And the breaking news the last 5 minutes is that the green shoe option was exercised. It's now $5.2 billion deal. And yeah, on the back of that, as we look at this hot and humid weather out there, in some way, it's also still raining here in Hong Kong.
More golden rays through the gray. I'm not talking poetry here. This is the line from Morgan Stanley here this morning from Laura Wang and her team, lifting their index targets for Chinese equities on the back of sustained improvement, also structurally, and the latest positive developments with tariffs and earnings. And they're seeing as bottoming out of ROE there.
Yeah, it's a bit golden rays through the gray. Yeah.
I love it.
Yeah, a bit deep for a Wednesday, but we'll take it. We'll take it. And I think to the point they were making there, right? So fundamental forecasts are up, and then the projections as well are coming up as well. And, Morgan Stanley, simply the latest of the banks here to have come out and revise higher again. They've really had a roundabout as far as their projections go, as far as Wall Street banks. But anyway, we'll talk about that in a moment. 0.4 of 1%, because Goldman actually also revised higher their projections recently. We'll get Goldman in a moment here to help unpack, read the thinking behind that. Right, against the backdrop of, so markets doing well, we'll get to CATL, which is still doing well, day 2. The other risk to tell you about, though, is the CNN report that has really, I think, in some ways, seen a market reaction in some parts of the oil market, clearly 1.5%. Gold is still a bit, although we're coming off highs a little bit. U.S. futures are continuing to react, and, of course, Aussie yen there as a risk barometer. Oil stocks are trading to the upside. Last we checked, because of the prices we're seeing in Brent, West Texas, and coming up on your screens very shortly there, some of the oil counters to tell you about. There we go, on your screens. Not a lot, but yeah, still seeing some upside here.
Yep, still focusing on what's going on in Israel and potentially Iran, according to CNN. Let's get to that Goldman call that came out just a few days ago. But they basically raised its 12-month index targets for both MSCI China and the CSI 300, and reverting back to levels seen before, Liberation Day, April 2nd, when President Trump announced those sweeping tariffs. So now that new target, 4,600 for CSI 300, 84 for MSCI China. Here to talk us more through that is Sifu, China portfolio strategist at Goldman Sachs. We were just joking at the break. The last time you came on was actually on Liberation Day. A lot has changed since then. What do you think has been the biggest sort of tailwind, do you think?
Yeah, definitely the truth of the retaliatory tariffs are welcomed by the market. We raised up our index target twice over the past months because of the tariff change. Our economists also revised up our GDP forecast from 4% to 4.6% now. So that's why we incorporate that into our model, and we raise our earnings forecast to 9% now. It's essentially back to the pre-liberalization day level as we forecast at the beginning of the year. And also we raised our index target to 84 for MSCI China and 4,600 for CSI 300. So basically, fundamentally, we reflect the changes that we are expecting less growth impact from the tariffs. And on valuation, we also raised the number because the sentiment-wise, flow-wise, we are also seeing some recovery, especially last week we have seen some hedge fund inflows coming back to the market, and 70% of the flow goes to the Asia market. So that's why we think it may support a little bit more upside for the Asia market in terms of valuation. So that's why we raise up our index target now. And sentiment-wise, we do see investors are getting more and more interested in the market again.
What's the assumption you're making on tariff levels with the projections now?
Currently, we are assuming 40% effective tariff rates from the U.S. This is what we are having now with the 90 days truce of the retaliatory tariff. That's also what we are assuming for the full year. Probably the tariff level will remain at a current level. But there is some uncertainty. People are still concerned possible changes after the 90 days. So that's why if we look at investor positioning, people haven't got very exciting. People are still quite cautious in terms of adding slightly more position at this moment and closely watching for any potential changes as well.
It seems like things are looking better. But then again, I think Winnie Wu from Bank of America, one of your peers, talked about what they're seeing in terms of long-only hedge funds and hedge funds, that there seems to be a reluctance to chase this rally because there isn't that sort of bottom-up ideas. You take a look at tech, they said mixed earnings. Take a look at consumption plays, has been boosted by government subsidies, but then again, that's to be fading soon. And then these new consumption plays like PopMart, for example, are getting very crowded.
Yeah.
Where do you look for then in terms of the pockets of opportunities?
Yeah, I agree with you. People are cautious or hesitate to add a position for the whole market, saying having a beta play. But more people are focusing still on alpha, on bottom-up stock picking. So it's challenging. I have to acknowledge it's quite challenging to pick the right stock at this moment. But a few themes I have seen interest. One is the shareholder return strategy, continue to attract inflows, especially from the long-term capital, like the pension capital. They are still willing to buy like companies with high dividend yield to have secured and stable returns. The other thing is, if you look at the key words when people are looking for ideas, one is domestic-oriented. The other is policy beneficiaries. So these are the key drivers as we see when you select stocks. Still, policy will remain supportive, especially if the tariff rates escalate again, then we are expecting more fiscal boost. In that case, these domestic policy beneficiaries will continue benefiting. And the other thing is people are still concerned about potential tariff risks. So domestic ones, consumer services, for example, internet companies, for example, people still like them.
Well, the earnings season is just about done. What's your takeaway so far? Is there any consistent theme that has stood out to you?
Yeah. So far, we see internet sector is still the leading one. We have seen double-digit earnings growth for the first quarter in aggregate for internet stocks. But A shares tends to be lag. In first quarter, it only have 5% earnings growth for all A shares. And last year, it's only 0% growth. It's fell behind the offshore companies. That remains a risk as we see because the consensus forecast is still high. So that's why we see potential downward earnings revision for A shares. But for offshore, it's in line with the expectation, 8% for MSCI China, which is in line with the full-year consensus forecast.
But you still prefer A shares over H right now?
Technically, in 3 months horizon, we think A shares may outperform H shares modestly because A share underperform H shares year to date. A share has close to zero return year to date, but MSCI rallied 16%, which is the best performing market in the region. So we still think A shares may narrow the gap a little bit. And also A shares are more supported by policies and the national team supporting domestic capital. So that's why we think technically A shares still have a chance to outperform a little bit.
I'm wondering, when you guys go out and talk to clients, whether there are new, let's say, not new clients, but new investors that you guys are now entertaining, because, we keep hearing that U.S. exceptionalism is over and some of that money is finding its way to Asia, EM, maybe to China. And I'm wondering, are you guys speaking to new investors? And is China a receptive trade idea now, given that there's money looking elsewhere outside of the U.S.?
Year to date, we do see more long-term investors, U.S.-based long-only investors are talking to us again after a few years. But they haven't been aggressively raising their position. They are still cautious, gradually build their position and focusing more on the companies with solid fundamentals, such as the internet sector. It's not as dramatic as like it happened in 2020, but marginally we do see increasing interest from long-only investors. That is what we are really willing to see.
What's still an underweight?
We are actually still cautious about like some cyclical or upstream sectors, given the deflationary pressure there. But we do think we recently raised our weightings for banks and property, which is something new. Historically, we were market weight or underweight these sectors, but we can't raise them because we think the shareholder return can give more support and policy give them more support. But for other upstream sectors like materials or energies, etc., they may still suffer from the lower PPI and deflationary pressure.
Fantastic. Thank you so much. So 4 revisions recently, and hopefully the last one to the upside remains for some time now, given just one could be forgiven for thinking nothing happened in April because we're effectively back to those levels, including the projections there from Goldman Sachs when lots of things happen. Sifu there, China portfolio manager at Goldman Sachs. And by the way, just on the point that we just heard there, so earlier on here on the China show, we spoke with HSBC Joe Little. So we talked about the alternatives to the U.S. And, he talked about if it's 10% earnings growth, I think Goldman had 9%, just look elsewhere because in China, for example, he thinks it's better bang for your buck. In fact, have a look at how he actually phrased it, way better than I did just now.
You can see the progression of the news around nominal GDP in China, for example. That's so important for the profit situation. And you've now got an outlook for the next 12 months where analysts are expecting 10% profits growth in China. It's the same as in the US. So why pay for the premium multiple when you can have that tech exposure in the rest of the China market, exciting themes on AI, robotics or biotech at a material discount to what you can access or what's being offered in other parts of global equity markets?
Right, just ahead here, Hong Kong-based biotech company Phase Scientific will be joining the shows here to talk about their medical testing products. COVID cases, of course, on the up. They're part of that story. The CEO and founder, Ricky Cho, joins us with perhaps something that the future holds for cancer testing as well. This is Bloomberg.
And it changes things materially. It changes relative valuations. It forces investors to think again about where safe assets are. And it challenges the growth story in US stocks, which had already become 70% of global equity market weight. And look, with hindsight, that looks like a
too much.
A top, doesn't it? A topping process. So profound implications, and then really big implications for other global bond markets.
Joe Little there, Global Chief Strategist at HSBC Asset Management, speaking to us earlier about the melt-up in those U.S. Treasury yields. And certainly the fiscal concerns come into the forefront out of the U.S. as well. And maybe that's, why we are seeing the worries around this credit downgrade that we saw from Moody's in the U.S. Just a few days ago, because you're seeing that being felt even in the pension fund market in Hong Kong. If anyone has an MPF, this is certainly one story that we're watching out for on the Bloomberg. Our source is telling us that there might be some forced selling of these treasuries because of these very strict mandates that they have. They can only keep about 10% of their assets for these sort of treasuries that have about a AAA rating. So now that that's been stripped out, what does that mean?
What do you replace it with?
Yes.
I think the analogy we like to use is the dating analogy is, if you're kind of picky on your criteria, needs to be this, 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 and this. If AAA is part of that, you need to look elsewhere, really. And where do you look for that replacement? And I think the other point we were making, too, was the other red story on the Bloomberg today was, when you look at the CFTC numbers, I think, one of the most active contracts is a play on the U.S. 10-year getting to 5%, right? So the Moody story isn't over. You have the Japan yield story, that weak auction 20-year, that's probably idiosyncratic to Japan. But again, the fiscal spending issues are coming to? Like, and do you have any business, I guess, being in the dollar? To some extent, maybe not, and longer dated bonds, I think, is the other question there.
That certainly is still the question here. And after we already saw the 30-year hit 5%, seems like the 10-year is getting close to that as well. Let's bring in Timothy Tan from Bloomberg Intelligence. He's with us right now. He doesn't come on air often, but usually when things are starting to crack, I think,
we
bring in Tim.
You save me for the last.
How do you see this U.S. downgrade impacting, in particular, the Asia dollar bond market?
Well, I think investors need to come to terms that when you're buying an Asia dollar bond, you're taking two credit risks. You're not just taking the issuer credit risk, you're also taking the credit risk of the U.S. government, which previously everyone thought was risk-free. Now, given the downgrades, and obviously there are a lot of imbalances in the system that potentially could make it worse, the risk of dollar depreciation or devaluation has risen significantly. Now, it may not matter to U.S. investors who are based in dollars, but for Asian investors, it's a big deal. Taiwan had the first hit in the beginning of May when they lost 10% simply from the currency move itself. Now, that is a red flag for most of Asia, and this is going to be reverberating throughout all Asian economies who happen to have one of the largest positions in U.S. debt and equity securities. So from the Asian point perspective, it simply means the current credit spread will need to adjust to take into account this additional risk factor. And it is not so easy to calculate, obviously, because how do you calculate the U.S. credit risk? It's not through the CDS, because nobody thinks the U.S. is going to default on payment.
We didn't have to think about it.
So you have to take what I call slight different angle, cross-currency swaps. You have to take out the U.S. dollar risk, which is the U.S. credit risk. So the cost of hedging is going to be very important for determining where spreads go widen to. Korea, I visited Korea last week. The clients were telling me, hey, the cost of hedging has risen sharply over the last week, simply because people are beginning to anticipate the risk and beginning to start to hedge. Now, that also means that Asian credit spread at some point will have to move accordingly.
Yeah.
The current spreads are just near record tights, which doesn't make a lot of sense if you think along those lines.
How does the increase in hedging, how does that then affect returns?
Well, credit spreads widen, obviously. And I mean, two components of yield, right? You've got the base yield, treasury yields, which obviously will remain volatile. It could be up and down, but at the end of the day, no one in the world actually thinks they're going to default on payment.
Yeah.
All right. On the other hand, you have the credit spread. Now, credit spread will have to take into account that currency hedge risks, right? The quick estimate, it may add 70 basis points on top of the current spreads to make it worthwhile, to remove the risk. So that will mean you can push the current spread of about 82 basis points to about 150. That's not a small move, huh? It's almost double.
It's double, yeah.
But then again, it could actually widen further if costs continue to rise. And at this stage, we do not anticipate that cost is going to come down anytime soon, because the structural depreciation of the dollar is beginning to gather momentum. Our own strategists believe that this is not just a short-term move. It's going to be structural. It's going to be long-term in nature.
During the break, and I think Yvonne and I just touched on that too, the AAA implications or the lack of AAA implications on Hong Kong funds. If you could explain that to us in what does it mean in simple English, and what can we likely expect to happen here?
Now, AAA funds, we call it, tend to say we need to buy the top tier credit. We can't buy anything lower.
Yes.
Now, as that AAA pool shrinks, most investors have begun to, or funds have begun to tweak their criteria to allow some sort of leeway between that. Hong Kong will probably have to follow, I suspect, because the size amount of AAA bonds out there in terms of sovereigns is actually very, very small relative to the US. This downgrading from the US, the US downgrade, there is no replacement AAA bonds that you can potentially invest into. So quite likely, I anticipate Hong Kong pension funds to tweak that, go to AA to AA plus, to as what I call the highest quality that they can hold.
Yeah. Okay. Thank you so much. That was fantastic.
At least giving an exception to treasuries. I think that's what I think the Investment Funds Association is what they're proposing right now.
Yeah.
To minimize the forced selling. Yeah.
Lower your standards.
Yeah.
Don't worry. But I mean, in dating sometimes, right? Again, back to the dating conversation. It isn't necessarily such a bad thing to do a downgrade, a down round sometimes, right?
I don't
there's
know
plenty of fish in the bigger parts of the ocean. If you think about Timothy Tan. You always bring the love here to the bond and credit markets. Thank you so much. Okay, an exclusive one coming through as well. If you didn't like that one with Tim Tan, maybe Jamie Dimon will be better for you. There we go. JP Morgan Chase, Chairman and CEO, joins us at those times on your screen. Stay tuned, of course, for that exclusive interview coming up on Bloomberg Television. Plenty more ahead. This is The China Show.
Well, let's focus on New World now. Bloomberg has learned that New World Development has asked banks to refinance more than $11 billion in debt by the end of June. Sources say the Hong Kong developer needs urgent relief as it faces the expiration next month of a covenant waiver on existing loans. Now, if the waiver expires before a refinancing deal, some banks could demand immediate repayment.
Yeah, let's bring in Shuli Ren, a Bloomberg opinion columnist, and she's been writing about this dance between the company, this perpetual dance. There's the play on words there between the company and the bankers. So this unusual decision to not call, of course, the perp. What implications do you think that's going to have? Explain that to us.
Well, if we want to talk about consequences, let me just start with to be sure. It's well within New World Development's right not to call or defer all interest payments. But its decision not to call is quite highly unusual. And if we want to talk about whether it has consequences, right, we need to look at precedents. And there are so few cases in Hong Kong. I could come up with only two. In May 2022, Richard Lee, Li Keqing's second son, Richard Lee's insurance company, FWD, decided not to call a perpetual bond. And FWD went away with it. They even got a ratings upgrade later that year, and they continue issuing bonds. On the other hand, last November, a Hong Kong-listed infrastructure builder, Roking, they decided not to call their perpetual bond as well. And Roking never recovered from that. So we don't really know. There are so few cases.
The key, you say, though, is the relationship with Chinese banks. Why?
Right. So New World is in the process of two separate big loan negotiations. One is the $11 billion refinancing loan, and the other is a $2 billion new loan that uses Victoria Dockside as a pledge, right? And it seems like the smaller lenders, Western banks, some of them are pulling out, and the Chinese banks will have to step in. In fact, in March, Chinese authorities asked the ICBC, Bank of China, and the China Construction Bank to look into New World's risk exposure and step in if the Western lenders decide to cut their credit lines. That's why New World needs to talk to the Chinese banks.
And how would they feel if the fact that they did not call?
So I asked some mainland Chinese traders. The answer they give me is very bad. Because in mainland China, only the big banks and the big industrial companies like Sinopec, etc., they get to issue perpetual bonds. And because they're so creditworthy, it's basically a routine operation for them to call back all the perpetuals when the first reset date comes. So it will be very unusual, and the Chinese bankers will get a little bit of cultural shock. And New World, unfortunately, they will have to do a lot of explanation.
All right, Shuli, thank you. Shuli Ren there, a Bloomberg opinion columnist. Make sure to check out her column today when it comes to New World and its perpetual dance with bankers. Take a look when it comes to markets here. We're focusing on some movers in particular. So BYD, that's the one in focus here. The shares are up some 3%. So Sudi boosting that price target when it comes to that strong export outlook, they say. They said they're more positioned to ride China's astonishing PHEV export growth. That's according to Citigroup analysts. PHEV.
PHEV. It's 4 letters.
What's the PH?
Certainly not Philippines.
I don't know. We'll figure it out.
Phosphate? Not Paris Hilton. The other 4 letters. Sorry, I've only had one 4-letter in my head.
Plug-in hybrid electric vehicle. I just Googled it. Okay.
There we go. PM, Pop Mart on your screens. 5%. New overweight at JP Morgan, $2.50 a pop is what you're seeing on the screens. And again, it's already at $2.17, so I think it's now up, I think, more than 10x since about 12 months ago. And yeah, I mean, this is really, I think, to the point we were making about BYD just now. The sell side is scrambling to keep up with their forecasts on the company share price.
Yeah, you gotta wonder if this crowded trade, if it can be more crowded. But I guess JP Morgan says still maybe some more upside. They're talking about 20%.
That's crazy.
From where they are now. Plenty more ahead. This is Bloomberg.
watching the data, and we have a little time to be patient because we've got policy in a good place. We're sort of in center position. So my reaction function is stay in center position and then be prepared to move agilely, but not abruptly or quickly when we don't need to because we don't have enough information.
Right now, I think the best action we can take is to sit on our hands and really carefully go through the data, engage with our communities, hear what they're thinking about, hear about the choices that they're making, and see how that all comes together in the aggregate data so that when we do have evidence of where we are, then we can make the right choices.
That was the San Francisco and Cleveland Fed presidents there reinforcing that wait-and-see message from the Fed. And we're watching very closely how Japan markets fare here. Take a look at how, as we approach that lunch break, and yeah, markets are, doing this right now, right? A lot of focus has been about the bond market, though. We're pretty flat on the stock, though. Topics is slightly higher, I should say, by 1/5 of 1%. But after we saw that weak auction in the long end, right, that certainly was one of the worst auctions we've seen for some time. There's
Since
a lot
2012.
of questions, of how long the sort of bond sell-off is going to be. We're already seeing that again in the 10-year. We're up some 2 basis points right now.
Yeah, across the long end of the curve there, certainly. I think in Japan's case, you're right. It's a BOJ stepping back story. You have lifers not coming in, and on top of that, there's also just the aversion, given the concerns around risk premium and government spending. The rest of the Asia Pacific, we're doing actually quite well. In fact, 6/10, 7/10 and 1%. Most sectors are up, with the exception of real estate. That's the bottom. That's in the bottom row of your screens. The dollar is on offer, and quite a bit, I should note. Given we're coming off as well as far as U.S. futures go. And, the risk aversion in some parts of the market really came about as the CNN reports, which we woke up to this morning, suggesting, well, many caveats to that story, that U.S. intelligence is suggesting that Israel may be preparing a strike on Iran's nuclear facilities. But again, all that said, it's in the oil markets and U.S. futures, not a whole lot across other parts of the market so far. And I hope it stays that way.
Yep. All right. Let's switch gears and talk a little bit more about what's happening here across the region. We have started to see an uptick in COVID cases, and health authorities here in Hong Kong and Singapore have warned that COVID-19 cases are surging as a resurgent wave spreads through the region. Joining us now is Ricky Chu, CEO and founder at Hong Kong-based biotech company Phase Scientific. Ricky, I know we thought we could put COVID in the back burner, but it seems like it's come back in focus for your business as well. How do you see this recent surge in COVID cases really affecting your business now?
Well, COVID is really here to stay, and we know that it's a seasonal thing. It would happen 1 or twice every year, and definitely there is a spike in the business as we are a major provider of COVID testing in the region. But however, we also see a lot of growth in our non-COVID business, and we definitely see that because of the pandemic, a need for self-help and a self-at-home testing is a very up-and-coming demand.
Yeah, I'd like to talk to you about that because certainly I'll be very careful with this because certainly a pandemic is no light thing. But one of the things the world learned from our bouts and experience with the pandemic was testing, right? To test more. And certainly, I think here in Hong Kong, anecdotally, as you would know, right? People, if you have something or have you tested, it's widely available. Have you seen a structural pickup in how the community approaches testing as it pertains to your business, for example?
Absolutely. I think for the longest time, people rely their health to the authority and the doctors. But I think since the pandemic, people now believe that with the appropriate tools, they can really control their own health by the at-home testing. And so that's why we are very bullish to see a very strong demand in the at-home testing area, where people can really test at the comfort of their own home. And we are in the business of developing very innovative urine-based assay where we can allow to detections of various infectious disease, women's health, and oncology application in near future, while we can all be very non-painful and non-invasive and at the comfort of their own home.
Right.
Yeah, can you tell us more on why you focus on these parts, like whether it's women's health, cancers, infectious diseases?
Right, absolutely. I think while first for infectious disease is well proven by COVID, and there is always an urgent need when symptoms shown, but the symptoms for infectious disease often vague. In order for the doctor to give you the precise, medication, you do want to know what exactly is your problem. So a rapid at-home testing is very helpful. For women's health, it's also quite obvious because there are a lot of compliance issues, right? And in addition, the privacy, the embarrassment of the current gold standard really warrants a huge demand, in at-home women's health testing. And lastly, for cancer, obviously, it's terminal because it's often too late when we go to see a doctor. So there's a strong demand for early cancer screening. But the screening must be able to be very accessible and very able to allow people to do that often in order to have the preventative effect.
Yeah, tell us more about that. This is something that you guys developed, the first urine concentration technology. I guess, how accurate so far is it based on your research and findings? And does it replace anything in the process thereafter, or is this something that you test at the start and then you go through the usual processes in place right now?
Yeah, well, we are very proud about what we have achieved because this technology is invented by me 10 years ago, and we have 10 years of history in perfecting this technology, which is the ability to concentrate the sample prior for detection. And we apply that particularly in the application of urine because we do see urine as the most convenient and most accessible samples for everyone to provide. And the first application that we do, for example, is in the application of HPV testing, where the gold standard is very invasive, and painful and embarrassing cervical swab. So, by simply providing a urine at home, we are able to get the same performance and accuracy compared to the gold standard where it requires a physician perform a swab.
You mentioned about the HPV test. It's already commercially available in Hong Kong, Ricky. What's your ambition for this test, in particular when it comes to usage and sales?
Well, we are looking for a global market here, and that's why we operate simultaneously in Hong Kong, mainland China, and in the US. And in all three sites, we do have our independent clinical laboratory, which are fully accredited by local authorities, which allow us to commercialize and perform and provide these innovative diagnostic solutions.
And what's so far been the reception from the medical community, from the doctors?
It's actually quite well received. In fact, just a couple of weeks ago, we do receive an award with our collaborator with ASTCP, which is the largest gynecology association in the United States, recognizing our research, the data that we provide of a urine test, an HPV test comparing to the gold standard cervical swab-based assay, and with the performance that are very equivalent to the gold standard, but with a much simpler and convenient sample type, we do see a huge potentials encouraging women, which honestly in this region of the world, half of the women that should be doing regular frequent screening are not doing so. We do see there's a huge market to penetrate into that and potentially saving a lot of lives.
Yeah, I guess I'm not alone in saying that, hopefully you're successful in getting this done because this is certainly there's much demand for this, certainly at home. You mentioned we're starting with HPV. I don't know how to phrase this question. I don't think I've ever thought about phrasing this question this way, but what else can we find in human pee apart from this?
Wow, almost everything, because everything that you can find in blood, ultimately they would go through your kidney and secrete out of the body through your urine. So urine is really the gold mine. However, for the longest time, scientists understand there are all the biomarkers in your urine, but you never really see a very strong applications in urine diagnostic because they are really technical challenges that no one able to crack. But we do believe that with our unique core technologies, we are able to address all of these technical challenges, and therefore we are able to launch, the next generation of this urine-based testing to really solve some of these major public health issues.
Fascinating stuff, Ricky. I'm going to ask you about the financials in some ways. You just completed the Series A funding, and you may raise about $34 million there. Certainly, that's a lot of money. Tell us a little bit more about what you could be doing with that sort of funding, and where do you see in terms of revenue forecasts moving forward?
Right. Well, first, we at Face Scientific are very proud about this achievement because it was 10 years in making. And I do believe the investors are really supporting us because of our vision and the unique core technology that we have. And I think the use of proceeds would really focusing in the area of the next generation urine diagnostic, both in the R&D pipeline. We do have a very strong, robust R&D pipeline, as well as the commercialization of the existing product, particularly in the urine HPV test, which we see a huge uptake in the preventions for cervical cancer.
What's your revenue situation like, Ricky? And for viewers watching, where can they find your products, if at all, in public?
Well, right. So I think in Hong Kong, we are the only brand that are penetrating into the two main retail channels. In Manning and Watson's, you can find our tests. I think in US, you would also find us in Amazon and in some of the major online channels like Walmart and such. And we just starting our commercialization effort in China. But at the moment that you can see us already in some of the major online channels like Jingdong and Meituan. And I think in terms of the revenue situation, we are at the tens of millions of dollars right now, and we do hope to double and triple that in recent years.
Nice.
Tens of millions of dollars. Sorry, I need to ask you: are you closer to 10 million, or are you closer to 100 million? That's a very wide gap, Ricky. Very quickly, if you could.
Of course. Well, we are in the range between 10 to 20 million dollars right now, and we hope to get to around $50 million. That's our target in the next 2 to 3 years.
Okay, well, okay. I know Series A has just done, so how far do you think before we actually see a listed company in Face Scientific? Is that part at all of a 3-year horizon, Ricky?
Well, I think in a high-growth biotech company, getting IPO is certainly one of our major milestones that we want to achieve. We do need the financial support to get to our vision. And that's why, completing Series A is definitely the very first step and also the preparation for us. While we are very open in the in IPO options, and we are preparing and we are waiting for the best timing to do so.
Ricky, fantastic. Thank you so much for joining us today. Ricky Cho there, CEO and founder at Face Scientific. Just an update of the oil markets. Oil, gold, risk assets, Aussie yen on the back of the CNN report out of Iran. And we're still seeing that somewhat, although that's paring back those trades really cross-asset going into the thick of the Wednesday session. This is the China Show. Right, welcome back. CATL, that continues to be the story today. On day 2, you have the founder and chair, Robin Zhang, pushing back on U.S. accusations that a company poses a national security threat. Now, Zhang told Bloomberg that a company has never sold any of its products to the military or for warfare.
Yeah, he was speaking in Hong Kong after the stellar debut of CATL's secondary listing, and the U.S. Defense Department has added the Chinese battery giant to a blacklist of companies with alleged links to the PLA. Now, on the flip side, you take a look at the stock right now, and yeah, investors continue to brush aside all of these concerns, right? The stock's up another 7% here today, and just the last few minutes or so, we did hear that they did exercise that green shoe option. So the proceeds now from this deal are now up $5.2 billion.
Yeah, quite a hefty deal already, right? And then it's even bigger still. Let's stick with the story of the company here. Certainly, it's one of the Chinese companies expanding in Europe as a way to avoid tariffs, but it's also facing some challenges on the continent. Our reporter, Josh Shao, in fact, is with us right now to take us through this. And Josh, you spoke, of course, with the European president of the company. Talk to us about how they outlined the challenges of the company in Europe.
Right, yes. So I think for CATL plants in Germany, some of the challenges that it has faced is, first of all, Germany is famous for its, or infamous in the sense, for its high energy costs. And I think that's something that, companies in Germany in general has to contend with. And I think, and that's something that Matthias Zengraf, when he was talking to us, he alluded to that as well, in the sense that, you can never expect something produced in Germany to be as price competitive as anywhere else. Another issue is the cultural barrier as well as the language barrier that comes with it. I think that's an issue that for Chinese companies expanding overseas that they all have to contend with, and some of the employees there was telling me that they need to rely on translation apps and sometimes even translators to sort of like get their ideas across, and I think that's sometimes it slows down the process as well, and in terms of cultural barrier, or in that sense, the labor relations is something that CATL's plants had to deal with as well. Two former employees was telling me that at one point in time, the German workers actually went on a little strike because there was not enough toilet paper in the toilets, and they perceive it as they read it as a sign as trying to force them to do more work instead of taking more toilet breaks.
Oh. Okay, so there's a bit of a culture shock, it seems. Josh, then, for any company in China that wants to go overseas, then, I mean, what lessons can they take from this CATL factory?
I mean, for Chinese companies going overseas in general, it has to, take those factors into consideration. How to deal with the labor laws locally, how to, make sure that your company sort of like brings together all nationalities. And I think more broadly, currently there's also the geopolitical factor at play here. Whether when you head overseas, you want to be careful that there's the Trump administration sort of like rallying countries to limit Chinese investments, but at the same time, Beijing is also hoping that those companies going overseas, they are not necessarily leaking, either intentionally or unintentionally leaking their key technologies to other countries. So I think those are the real calculations that companies have to take into consideration when they're expanding this day and age.
Yeah, if you could outline for us even further, what other forces are there or challenges that these Chinese companies that might be contending with these things for the very first time as they expand abroad? What does that list look like, and might it lead to fewer actually Chinese companies to consider going abroad and dealing with those problems?
I think at this point in time, expanding overseas still looks like the best option of the rest. And indeed, we have data, sort of backing it up. We have data from the China's forex regulator saying that, in the first quarter, actually there are the Chinese investments overseas still increased compared to a year ago. So that shows that even in this trade war era, even with all the uncertainty, I think going overseas is still the best possible option at the moment. But of course, you have to take into consideration of the cultural barrier, the language barrier, the labor culture, and also all those geopolitical forces that are at play. I mean, for Germany, it's also been talking about de-risking from China. For the U.S., it's been talking about trying to get together more countries together to limit Chinese investments, and for Beijing, of course, it wants companies to go overseas and sort of like it's a good sort of like a spread of influence, but at the same time, it also doesn't want too many companies to go overseas at the same time, and it could weigh on the local employment situation as well.
Josh, great insights, great reporting there. Thank you so much for bringing that story to us. Josh Xiao in Singapore. Of course, you can read more on Josh's story on the terminal right now. We got plenty more ahead. This is Bloomberg. Oh, welcome back. Taiwanese computer maker Asus says the uncertainties caused by tariffs will mean very little expansion of the market this year. Co-CEO Samson Hu told us the new crop of AI-powered PCs will take until 2026 or later to drive the sector forward.
I think we continue to see strong demand for AI. That's because AI is no longer optional for business, since it really helps them to improve operation efficiency and to stay competitive.
Agentic AI, though, that was a big topic for 2025, and this move to the edge that we were going to be seeing, or we will see in smartphones and PCs. Mm-hmm. We haven't really seen it, though, spark an upgrade cycle just yet, it seems.
Well, I think it still takes time to have the agentic AI application into every edge devices, including AI PC, smartphone, and edge computing devices. I think it still takes time, but it's ongoing. So we are optimistic about its future.
If you think, though, about the timeline for this,
I think that maybe 1 year, 1 year or 2 years, because the hardware capability already there, but it still depends on the third-party application developer to develop those applications based on agentic AI technology.
what sort of demand are you forecasting then for this year, or sales for this year, if you don't see that move to the edge or in-device AI happening until 26 or 2027?
I think the market momentum still highly depends on the driving factor from the industry, but also highly affected by macroeconomic factor. So overall, original estimation of the market growth rate for the PC industry is around 5%. But right now, because of the tariff policy uncertainty, I think right now most estimation already are reduced to 1% or 2% or even only flat.
And that's also what you're expecting for ASUS for this year?
Yes, we have the same perspective. Yeah.
The PC sales stay...
PC growth rate will be low single digit percent.
Low single digit to even zero flat.
Very possibly. Yeah.
And yeah, that was the co-CEO of ASUS, Samson Hu, speaking with Bell, of course, there at Computex in Taiwan. Just very briefly, before we wrap the show up, look at some of the equity movers across the region here. Korean nuclear stocks on the up. Samsung C&T leading that charge here on, I guess, demand of prospects picking up and demand prospects picking up. Same on power and energy, but this shifting to China, and we're looking at more old school power and coal shares rallying, as certainly you are getting this high temperature wave across many parts of the Asia-Pacific, really leading to, I guess, spike in demand here for things like air conditioning and perhaps more in-store as well. BYD was a big story, too.
Yeah, that's the city call there when they say they're boosting the outlook and price target just based on the export outlook. So this is what they're talking, these plug-in hybrid EVs, where they do have a lot of room to run there. Certainly one to watch still is CATL. So, yes, they did exercise the green shoe option, and now those proceeds have been raised to $5.2 billion. Just given the strong demand, and there you go, still session highs for the stock today.
Yeah, it's now up $70, give or take, there from the listing price. We'll leave you with a look at the Hang Seng Index, where Morgan Stanley just today raised their forecasts here, their base index targets for Chinese benchmarks here to now 24.5 on the Hang Seng Index. We'll see you all tomorrow.